This is the story of how one accountant's routine review of a trucking company's tax filings uncovered a laundering pipeline moving more than $40 million. What she found didn't just expose one dirty business, it led federal agents straight into a nationwide fraud network built to drain the savings of American seniors, one phone call at a time. Here's how they followed the money and how much further it went than anyone expected. The company that looked too clean. Meridian Freight Solutions operated out of a low, unremarkable warehouse on the industrial edge of Canton, Ohio, with 22 employees and a small fleet of leased box trucks hauling furniture and appliances for a handful of regional retailers. It was the kind of business you'd drive past 1,000 times in your life and never think about once. Nothing about the sign out front or the trucks in the lot suggesting anything unusual at all. And that, it turns out, was exactly the point. Meridian was too consistent. Quarter after quarter, its revenue climbed by almost the exact same percentage, and its profit margins never dipped, not even in months when fuel prices spiked and every other trucking company in the region posted losses. Most small businesses have a bad stretch now and then, a slow season, a client who pays late. Meridian didn't seem to have any of that, and to most people that would look like tight management. To the right set of trained eyes, though, it looked like a company that had reverse-engineered its own books, working backward from a number it wanted, rather than forward from what it actually earned. Those eyes belonged to an analyst with the IRS Criminal Investigation Division, agents who specialize in chasing money instead of chasing suspects. The case landed on her desk almost by accident, after a bank flagged Meridian for a pattern connected to something called a currency transaction report. A series of deposits all just under the $10,000 line that triggers automatic reporting, spread carefully across 3 separate business accounts. That pattern has a name. Investigators call it structuring, and it's one of the oldest tricks in financial crime, almost as old as banking regulation itself. And once you know what to look for, it's also one of the easiest to catch. She pulled 3 years of Meridian's banking history. At the time, it was just one more file on a long list of flagged accounts. And she had no idea that this single request would end up unraveling one of the largest elder fraud laundering operations investigators in the region had ever traced. This is where financial crime starts looking nothing like it did a generation ago. Investigators who've been doing this work since the 80s and 90s remember when fraud meant a briefcase of cash changing hands in a parking lot, or a con man running the same trick door to door. That era hasn't disappeared entirely, but it's fading fast, and what replaced it is quieter and, in a lot of ways, harder to catch. Spreadsheets instead of suitcases, wire transfers instead of handshakes. The crime moved online and onto the banking system, and the investigators chasing it moved right along with it. The first red flags. The records told a strange story almost immediately. Meridian's official client list was small, just a handful of furniture retailers, none large enough to generate anywhere near the cash flow the company was reporting. But wire transfers were pouring in from more than 60 different individuals spread across 11 states, in amounts ranging from $4,000 all the way up to nearly $90,000, with transfer descriptions that were vague at best, things like consulting services or logistics deposit, or blank entirely. None of it matched a furniture hauling business, not even close. The analyst brought her findings to the FBI's Financial Crimes Squad, and that's where the case gained real weight. Agents pulled the names attached to those wire transfers and started working down the list, making phone calls one by one, and the pattern that came back was almost uniform. These were elderly account holders, most of them in their 70s and 80s, and nearly all of them told some version of the same story. They'd been told the money was needed to release a prize they'd already won, or to cover a customs fee on a package supposedly stuck at the border, or, in some of the harder cases to hear, to keep a grandchild out of jail after a car accident that never happened. Several victims described being coached in real time by someone patient and reassuring to avoid telling their own bank the real reason for the transfer. One woman told agents she'd been on the phone for nearly 4 hours the day she sent her money, guided step by step through exactly what to say at the counter. A retired school teacher in his 80s said the caller knew his late wife's name, his grandchildren's names, even which church he attended. Small details gathered ahead of time that made the whole call feel personal instead of random. That's not luck. That's research, done in advance, the same way a salesperson studies a client before a pitch. For investigators, this is the moment a case changes shape entirely. A business account that looks legitimate on the surface quietly swallowing money that has nothing to do with what the business actually does, isn't sloppy bookkeeping. It's a laundering front. Meridian Freight wasn't hauling furniture with that money. It was cleaning it, one wire transfer at a time. Following the paper trail. Once agents confirmed the incoming wires were tied to fraud victims, the entire investigation shifted, and the question stopped being whether Meridian was a real business. The question became where the money went once it landed. That answer took months to find, because whoever built Meridian's financial structure had built it specifically to slow investigators down, maybe even to stop them entirely. Money entering Meridian's accounts didn't sit still. Within days, sometimes hours, it moved out again to a second company, a so-called logistics consulting firm registered in Delaware with no physical office and exactly one listed employee. From there, it split again, funneled into a chain of limited liability companies scattered across 3 different states, each one holding the funds for only a few days before pushing them further down the line, like water moving through a series of locks. By the time agents finished mapping it out, they'd found 14 separate shell companies, all feeding into and out of each other in a loop designed for one purpose only: to make the money's original source completely unrecognizable by the time it reached wherever it was really going. This is where forensic accounting stops looking like paperwork and starts looking like detective work. Agents subpoenaed formation documents for every one of those companies and kept finding the same 3 registered agents attached to them, again and again, professional incorporators who set up businesses for a fee without asking too many questions about who was really behind them. Bank statements showed round-dollar transfers, timed within hours of each other, over and over, and that kind of precision is a signature. Legitimate businesses don't move money on a schedule that clean. Criminal networks do, because every extra hour a dollar sits still is an hour it can be traced. Slowly, the real shape of the case came into focus. Meridian wasn't the source of the fraud at all. It was one node, a single cleaning station inside a much larger financial network, and most of that network wasn't even in Ohio. The trail widens. By month 8 of the investigation, agents had identified nearly identical shell structures operating in Nevada, in Georgia, and in Texas, each one running the exact same playbook. A legitimate-looking small business absorbed wire transfers from elderly victims, then funneled that money through layers of LLCs before it reached its final destination. And the final destination was the real discovery. Roughly 60% of the laundered funds were being converted into cryptocurrency, moving through a small handful of exchange accounts before landing in digital wallets. Investigators, using blockchain analysis, and eventually a few cooperating witnesses who agreed to talk in exchange for leniency, traced those wallets back to a call center operation running out of leased office space overseas. That call center was coordinating with a domestic network of what agents came to call runners, people whose entire job was opening shell companies, signing paperwork, and processing wire transfers for a cut of the proceeds. Here's the part that made even veteran investigators pause. The call center wasn't running one scam, it was running several, all at once, out of the same building. Fake lottery winnings, grandparent emergency calls with someone impersonating a jailed relative desperate for bail money, long-running romance scams built over months of manufactured relationships with lonely widows and widowers who genuinely believed they'd found companionship, some of them even planning to meet in person. Different scripts, different victims, completely different emotional angles tailored to whoever picked up the phone. But underneath every single one of them sat the same laundering machine, because cleaning stolen money is its own specialized skill, separate from the con itself. Criminal operations increasingly don't even try to handle it in-house. They outsource it, the same way any business outsources the part it isn't good at. Investigators sometimes compare it to a factory with different departments. One team writes the scripts and trains the callers, another recruits the runners who set up the shell companies, and a third handles nothing but moving money once it's in the door. Nobody in any single department needs to understand the whole operation, which also means nobody arrested in one department can fully explain the rest of it, even if they want to cooperate. It's a structure built for resilience as much as profit, and that's part of why these networks are so hard to shut down completely, even after a major arrest. What began with one accountant noticing that a trucking company's numbers were a little too tidy had become a case spanning 6 states, well over 100 identified victims, and a laundering network built specifically to serve elder fraud operations on an industrial scale. The raid. By the time the FBI and IRS criminal investigation were ready to move, agents had built a financial map detailed enough to know exactly which accounts to freeze and exactly which doors to knock on, and just as important, to hit all of them at the exact same moment. That timing mattered more than almost anything else in the operation, because one warning call anywhere in the network could have sent every remaining dollar disappearing within minutes, gone before a single warrant was served. On the morning of the operation, agents executed coordinated search warrants at Meridian's warehouse in Canton and at 4 other locations tied to the Shell Company network, including a strip mall office in Las Vegas that turned out to be nothing more than a mail forwarding address, a laptop, and an empty filing cabinet. Investigators seized business records, computers, and just over $2 million in funds that hadn't yet been moved out of the pipeline. At Meridian itself, the man who'd built and run the company, someone who'd presented himself around town as an ordinary small business owner active in the local chamber of commerce, was taken into custody without incident. The employees on the warehouse floor had a much harder morning. Most of them had spent months, some of them years, loading trucks for a company they had no idea was actually turning its profit somewhere else entirely. The prosecution. The charges matched the scale of what agents had uncovered: conspiracy to commit money laundering, wire fraud, and structuring financial transactions specifically to evade federal reporting requirements. Prosecutors built their case less around dramatic confrontation and more around the paper trail itself, the layered companies, the round dollar transfers, the timing patterns that no legitimate business could ever explain away, no matter how good the lawyers were. That paper trail is exactly what makes cases like this so difficult to fight in court. A defendant can argue about intent or claim they didn't fully understand where the money was coming from, but it's much harder to argue with a spreadsheet showing $92,000 entering an account and leaving again, almost to the dollar, 4 hours later. Juries tend to understand that kind of pattern even without a finance background, because money doesn't move like that by accident. Sentencing in cases of this size typically means years behind bars, not months, for the people who built and ran the laundering infrastructure. Courts don't just weigh the dollar amount, they weigh the number of victims and how vulnerable those victims were. And in elder fraud cases specifically, judges have increasingly treated the deliberate targeting of older Americans as an aggravating factor in sentencing, not just background detail in the case file. Restitution is part of these sentences too, at least on paper, and judges routinely order defendants to repay victims in full. In practice, recovery tells a different story. By the time a case like this reaches sentencing, most of the money has already been converted, moved overseas, or spent, and prosecutors are often upfront about that with victims, even while pursuing the order, because raising false hope about getting the money back only adds a second injury to the first. What it left behind. Here's the hard truth about a case like this one. Most of the victims were never going to see their money again, and that's the entire point of a laundering operation built this carefully. By the time anyone notices the money is gone, it's already unrecognizable, already 3 states and 14 shell companies away from where it started. But the case still accomplished something real. It mapped out a laundering method that has become far more common and far harder to spot than the crude, cash-in-an-envelope schemes of a decade or two ago. Legitimate-looking small businesses quietly used as cleaning stations for fraud proceeds, hiding in plain sight in ordinary towns across the country, the kind of towns where everyone assumes they'd notice if something was wrong. And that's really what this whole case comes down to. It didn't start with a tip about a scam, and it didn't start with a victim's phone call to the police. It started with a forensic accountant looking at a trucking company's numbers and noticing they were just a little too perfect to be real. Following that single thread, patiently and methodically, through 14 shell companies and 3 states' worth of banking records, is what eventually unraveled a nationwide fraud network built to prey on some of the most trusting people in the country. The agents never set out to find an elder fraud ring. They set out to understand where one small company's money was really coming from. And that's the pattern behind almost every case like this one. The fraud isn't found by chasing the scam itself. It's found by following the money until it stops making sense, and then following it a little further, patiently, until finally it does.